Hi everyone, this is Paul Cooper with Totes and Notes, and I'm bringing the third video in our Profits and Loss series. So let's get started. Just another quick disclaimer, I'm going to have this up for a few seconds. It's been on all the previous ones, but mainly just make sure to get good licensed professional advice whenever you need it and to get good counsel. Here are the series topics and key points. Again, this has pretty much been the same for everything. Just make sure that, don't get suckered into any one thing. No investment's perfect. Here's a quick recap. So from the previous two episodes, we've learned that dividends and dollar cost averaging only shorten the time needed to break even, but most investors don't actually dollar cost average, or they don't do it enough. Most adults only have one or two market cycles, not 90 plus years, especially when most adults don't start saving until they're 35 or so. Inflation, market corrections, and low savings rates are working against you. Investing discipline and diversity can help improve returns and security. So this week's profit would be Grant Cardone, Uncle Grant, your uncle that's the real estate mogul. If you don't know who Grant Cardone is, he's a fairly successful sales guru, motivational guru, and real estate investor. He grew up in, I believe it was Lake Charles, Louisiana, very poor household. His father died when he was fairly young, always worked really hard. He got into some trouble in about his late teens and through most of his 20s. He was very honest about it. He talks about how he used to drink all the time and do lots of drugs, and he just was going nowhere, and he was probably going to end up dead or in jail. He eventually kind of got his act together and got a sales job, and he really tried to make sales a profession. He spent a lot of time training it, recapping things, going to seminars, listening to audio tapes, and he would actually practice and make it a profession as opposed to just a numbers game where people would come in and, every 10th person maybe you sell. He's written quite a few books. Most of his books are also audio books. I've read and listened to a few of them. He's got a few on, he's got a lot of them on sales training and how to be better at sales. He's got a lot of programs. He's got a website. He's got a university to do it. He's also done a lot of books on just kind of personal finance, motivation, and some on real estate. He has his own TV, the Grant Cardone TV, where he has quite a few different shows on there, ranging from getting your money right to real estate investing to other business and entrepreneurship topics. His main thing now, besides his selling of his training, his sales training, where he's made a lot of money. It's hard to tell how much he's actually made and where he makes most of it from. I would say most of it's probably been made through the sales, or at least that's where he's made the money that he used to go on and make more money in real estate. And what his real estate investing concept is he basically goes out and finds large apartment buildings and complexes, something that's not terrible, but something where there's a little bit of value add. He goes in, buys them, has the economy of scales working for him for his management company and things like that, puts a little bit of value add in it, gets to the appreciation, collects rents, starts charging more rents, and then gets out in a few years. And he syndicates these deals. Most of them are going to be funded through some type of investor. He almost always does general soliciting, so he uses accredited investors. If you ever watch any of his TV shows, episodes, they'll talk about it. They'll have people call in asking how they can invest with him, and he tells them, you got to be accredited and, what the minimum investment amount is. So that's a little bit about Grant, and now we're going to cover some of the things that I like and don't dislike about him, things that I think are good and bad. I do like a lot of his. I'm not super into motivational stuff, but I do think he puts out a lot of good stuff about getting your head right around money. If you look in the bottom right here, the screen beneath this picture, he's constantly quoted as saying, "Success is your duty, obligation, and responsibility." Takes that very seriously. If you watch any of his finance stuff, he'll make you realize, like, you thought you were doing well, you probably need more money just because you're really only one lawsuit, bad accident, or medical event away from most people being broke. And he doesn't necessarily do it to fearmonger or anything like that. It's just to kind of get your head right and that you should probably be doing better and you could be doing better. And a lot of the middle class mentality on get rich super slowly, save a little bit here and there, and then 40 plus years, hopefully you've got $1 million. And so I think he does well on that. He's kind of a new age guru, and I think he's got a lot of good things to say about that. Where I disagree with him is on his sales stuff. If you read any of it, some of it's good. A lot of it seems very pushy, sleazy, and I would almost say insulting. Where if I was someone was trying to sell me a car and they said a lot of that stuff, I'd be like, okay, well, I'm never buying from you because that's incredibly insulting or stupid. And a lot of it's pushy, and it seems very slick, sleazy car salesman. But then a lot of it's really good too, and so I'm not going to go through all of his different sayings and how to treat situations, but I would say some of it's high pressure sales tactics to kind of get people to buy stuff. And I think that in the long run, if you were to follow them, you'd have a lot of customers that really weren't satisfied in the end, even if they did buy. That's just my opinion on that. His real estate investing and financial views, again, we kind of covered those briefly. Personal finances, good. The thing that I really don't like about him is he's constantly telling people to go out there and invest in apartments. And, apartments have traditionally been a pretty good investment because maybe you get a little bit of appreciation and you're getting good cash flow. The problem with that is apartments have never been more overvalued as an asset class. Extremely overvalued. Everyone wants to buy apartments. People are like, oh, I'd love to get a discounted apartment. There aren't discounted apartments. Everything's overvalued. And the issue with that is there are a lot of new apartments being built constantly. Larger cities like Denver right now is insane. They're building a ton of new apartments and they're coming online. And so it's ultimately going to cause rental rates to go down. He likes them because the cash flow and economy of scale, but then he also likes apartments because he sees the coming crash, and I think a lot of us are seeing that the economy's starting to sour, and he thinks that the personal residence, the home, is going to basically go by the wayside and will never recover. Values will drop. People won't be able to afford it. And he's like, well, then everyone's going to have to rent. And that does make some sense, but at the same time, just because you have to rent doesn't mean you can't rent a house. It doesn't mean you have to go to an apartment. And if everyone's losing their homes, yes, home values will go down, but then there are going to be all these, homes that are foreclosed on that need to be sold or rented out. So I don't think homes are just going to disappear. I do agree with him that a lot of people view a home purchase as an investment, and it's really not necessarily a good investment as far as financially. There's always the aspect that you're providing a good spot for your family. So emotionally and support-wise, it can be a great investment, but financially speaking, a home's not always a good investment. And I do agree with that. I just think his sales stuff's a little pushy. His views on apartments being the end-all be-all of real estate, I think it's going to get him in trouble. But again, very talented individual. He's done extremely well from himself, coming virtually, super poor, to owning Gulfstream aircraft and traveling around the country and world and speaking to people. So he's done very well for himself. Definitely don't hate the guy or anything, just trying to give you both sides of the coin. So let's move on to our more analytical side of the profit and loss episode. So part 3, it's called the value of a cape. And we're going to get to what the cape is and why you should value it. All right, stock valuations drive returns. That's mainly going to be the theme for this episode. And the cape that I alluded to in the previous slide stands for the Shiller Cyclically Adjusted Price to Earning Ratio, CAPE for short. And basically what it does is it takes the value and the earnings of a stock and it compares them, and it makes this ratio that helps you know if an asset's overvalued or not. And it's nice. This is different than some of the other earning ratios because they do take a longer term valuations using 10-year averages. So you get a much longer and more averaged out view as opposed to a very short period that could be averaged and either look good or bad depending on if the economy was good or bad. If you've followed stock for a while, you've probably heard of CAPE. It's a very good tool to use. Right now, generally what they say is if a stock is valued on the CAPE scale at 10 or less, then it's generally going to be undervalued. And if it's 20 and above, then generally things are overvalued. And if it's in the mid-teens range, then that would be normal. And we'll talk about how you can use this. But the main thing is when valuations are elevated, returns are lower. And that just makes sense because if an asset is valued higher now and you're having to pay for it now, then you're going to earn less on it in the future. Because if you're paying $50 for something now and then in the future it's going to be worth $100, that's going to only be $50. Whereas if you're able to pay $25 for it now and then have it be worth $100 in the future, it's $75 is the difference. So that should make pretty logical sense, that the more you're having to pay, the more something's valued now, then generally the less you're going to be able to get for it in the future as far as total profit for the same price. And valuations can revert back to normal levels, but it's usually done theoretically by one of two ways. And that's when the earnings could increase rapidly while the values stay flat. So let's say a stock is worth $100. Maybe they start paying a dividend, a fairly large dividend, but the stock price remains at $100. That would be that case. It just doesn't happen. Earnings never increase drastically like that, and then the stock stays the same price. What generally happens is prices decline rapidly. You're going to get a crash. So things are going to be overvalued for a long time, and then finally the market's going to wake up. Everyone's going to be have the price is going to be beaten down, and that's generally what happens. Which, if you don't see it coming, that's pretty bad because now you're stuck, and now you're get into one of those periods where your money is going to be working just to get back to even for a long period of time. So here's a quick example, and again, this is from a series of articles. You can see it on Zero Hedge here. Here's the website link. And a lot of these charts and a lot of this information is from the Real Investment Advice. Great people. I've talked about their stuff the past few episodes. But here's a nice chart they did. So it's a 30-year forward annual return from P and E levels, price and earning levels. And so it's talking about CAPE, price and earning. If the ratio is 10 or less, you can look over here. As the ratio as the P and E is less, the more likely you're going to make a higher return in the long run. So as you can see here at 10, it's averaging about 8%, maybe a little bit higher. And then as it goes out here, the whole scatter plot starts increasing. Whereas if you look at the other side, once it starts getting about 18 and above, it starts decreasing pretty dramatically. So, people are saying that you're going to get 8 to 10%. Well, if you're buying when the P&E is 20% or 20 times or more, then in the future you're likely not going to make that because you bought it when everything was so expensive. So hopefully that makes sense. Green means the lower area where it's good, you're likely going to make higher returns. The red area is 20 and above. That's going to be the more expensive area where you're likely to make less returns. And then, like we talked about, mid-teens, kind of the average area. And again, we're just going to talk about that a little bit more. It's the logic and math behind it. If you overpay today, then future profits will be lower. I think we've kind of shown that. The saying is basically in all assets, you make your money when you buy. Buy right, get things at a discount, and that will help you create profit in the future. Here's the math formula behind it. And again, if you go to the article, they give you an example that's pretty good where they actually fill this in. I don't know. Do this if you want, but I think logically you understand what's going on here. There's this really nice quote from Warren Buffett I like. Price is what you pay, value is what you get. And Warren Buffett's been known as the ultimate value investor. So that's what it is. Just because you're paying a lot for something now doesn't mean it actually has that value. Because people see the stock market like, oh, everything's up. That must mean everything's worth it. No. The price and the value don't always go hand in hand, unfortunately. So you want to find stuff that's at a good price and has a lot of value. All right, this slide is called 10% return equals 100% problematic, and the reasoning behind this is most financial advisors will tell you that you can make 10% regularly and through investing through equities and stocks, and that 10% is all you need and that you should be good. Well, this is problematic because, one, most people aren't going to make 10% compounded regularly, and then two, it doesn't take into effect the valuations of what you're buying, and it also doesn't take into effect the taxation and withdrawal rate. This chart here doesn't deal necessarily with the taxation withdrawal rate, but this is going to deals with a $3,000 cost averaging annually invested at 10% compound at different price levels, different P&Es at 20 and at 10. So the red line here is if you just did the $3,000 annually and it was compounded at 10% regularly. No one gets this, but this is that nice smooth line. This is what they tell you should be able to get, even though you're not going to. The blue line here is if you were to do the $3,000 cost averaging annually, and you invested in a stock or stocks that were at a 10 P&E or less, so they're undervalued, you're getting them at a good price. And then this yellow line here is if you were to get them at a bad price, you were purchasing the same assets at a 20 times P&E or greater. So red, remember, is like the perfect model. Blue is more realistic and achievable if you get it at a good price. Yellow is what most people are actually going to do, because right now things are really overvalued. People are going to buy overvalued assets, and you're not going to get that 10% annual. And then especially when you're buying stuff at a higher price, you're limiting your upside. If you look at it here, it takes about 22 years before investing at 20 times P&E does better than a mattress savings program. And the mattress saving program is you literally take $3,000 a year and put it in your mattress. And that was actually this purple area here. So if you look at it, it's basically staying right at there, and then, oh, now it finally starts getting above it. 22 years. That's pretty crazy for no returns and a lot of risk. And then if you look at the blue area here, this is the shortfall for investing at 10 times P&E. So again, that's basically just this area between the blue line and the red line here. And then the orange area would be the yellow line and the red line. So this is if you were to get in at 20 times or greater P&E. So pretty significant shortfalls. Blue's not nearly as bad. And honestly, considering no one's going to get this nice perfect red line where you're getting 10% compounded annually year after year, it's pretty good. So it just helps illustrate. You make your money when you buy. You got to be really careful that you don't get sucked in and buy assets when they're overvalued. Now, just because something does have a high P&E ratio doesn't necessarily mean it doesn't have any value. It very well could. It could be a stock that's about to take off, but you're generally not going to see that on more established, less risky assets. That would be something that maybe has been doing well for a while, and then they're about to have a big breakthrough. All right, so our next chart here, again from Real Investment Advice, we're going to elaborate on the 22 years. So it's 22 years of catch 22. So 22 years to opportunity. So the thing is when markets have been overvalued, they basically calculated that it takes roughly 22 years to get back to normal, to recover from an overvalued market. And this chart here just kind of illustrates some different time periods where this is true. So it's not like they're taking one time period that just randomly happened to make things look bad. Like a lot of advisors will do the exact opposite and choose like a really good bull market and be like, oh yeah, see, they made 20% during these 20 years. So that means, you should easily be able to get 10%, or they'll take a really shortened recessionary period and then a really long bull market to make things look good. This is a pretty long picture here, over 100 years, and it has basically 4 phases here where it's taken roughly 22 years to get back to normal from overvaluation. So again, I really hope this helped illustrate to everyone how overvaluations and undervaluations and just the value of stock in general really drives your return. Hopefully you'll do a little bit more research about the CAPE ratio and how it can be used as a tool to value or to show the value of an asset and whether or not you should buy in it. It's a pretty good tool. If people are really interested, I can show you more. But really, you can basically go to almost any website, financial website or brokerage, and they can generally calculate the CAPE ratio for you. It's not hard, and so it's just a good tool to look at. It's not the end all be all. There really isn't one. But it can definitely help sober you up a little bit if you're starting to get some type of stock fever. Again, I hope you enjoyed this episode. I hope you look into Grant Cardone a little bit more if you hadn't heard about him, learn the good and the bad. I hope you spend some time at Real Investment Advice or going to their articles. Get good information. And I look forward to talking to you all next week, and I appreciate your time. Thank you.